Well, good afternoon, everyone. We're going to give a few more attendees just a moment here to log in, and we will start shortly. All right, everyone. Good afternoon first. Boy, have we got a timely website for you today. This month, we wanted to do something a little different. You know, we have a monthly compliance session, and focus is typically on compliance, and we do have other subjects we've discussed. But one thing that always comes up this time of year is year-end accounting. And so, Steve and I, talking with our guests today, thought, what a great time of year to talk about these things with our customers. So, with that, I will go ahead and, my name's Richard Hudson with Ignite Consulting, and I'm here with
Steve Levine from Ignite Consulting, and just want to tell everybody how excited I am about this month's session. Like Richard said, that this question of accounting issues comes up. Usually it comes up like mid-December, and people call in a panic. So we thought it was timely to kind of try to beat the clock on that and get you thinking about these issues a few months ahead of time. And it's always
coincidentally, some of the subjects we talked about here came up with clients for both Steve and myself yesterday. So these are timely. These are things we're dealing with on a day-to-day basis. So with no further ado, I would like to introduce our guests, Amanda Butler Sanchez and Hugo Sanchez. Amanda and Hugo, would you like to do a brief introduction of yourselves?
Sure. Thank you, Richard, and thank you, Steve. First, I want to thank you guys at Ignite for inviting us to participate today. These webinars are such a wonderful resource for the industry, and we are really excited that we're able to contribute and help out with some of this information for the industry. My name is Amanda Sanchez. I am a CPA. I'm the accounting partner at Butler & Sanchez Certified Public Accountants. We serve independent dealers across the country, primarily buy here, pay here, and help them with accounting and tax services.
Hey everyone, my name is Hugo Sanchez. I am the tax partner at Butler & Sanchez LLC, and I just focus on all things tax for our firm.
Thank you, Amanda and Hugo. We are so excited to have you today. And I have two more points I'll make before we move on, and that is there are two downloads attached to the session. They're called handouts in your login area. So go ahead and download those. One is the certificate of completion to show that you have attended, and the other is the slide deck. If you maybe like to download that and use it as a checklist for you going forward. The last thing I'll mention here is questions. We are really excited when we get questions. How often do you have 4 experts in the industry on the phone who are here who can either answer your questions or will find you the answers to those questions? So take advantage of that opportunity. If we don't get to your questions by the end of the webinar today, we will reach out to you one-on-one. So with that, we will move on to the next slide here, and this is our normal disclaimer. Is this is not considered legal advice. Again, this is also not considered accounting advice. We're going to talk about a lot of different subjects here, but like compliance, accounting is nuanced, and there's a lot of gray. And so you really need to have an expert by your side when you're making decisions about the things that we're going to talk about. So definitely reach out and talk to someone, but don't make those decisions on your own. And so here we go. First thing is the topics of discussion. We're going to cover these topics today. I'm not going to laundry list these, but these were some of the major items that we feel come up most frequently when dealing with year-end topics. So with that, I will throw this out to our guests here. The importance of interim financial statements. Give it a go.
Okay, so I'll take this one. So an interim financial statement, basically that just means your financial statements prepared sometime throughout the year rather than just an annual financial statement. So Richard had mentioned that this is the perfect time of year to talk about this stuff, and he's exactly right. And the reason is that having a financial statement prepared as of September 30th is necessary. I'm not even going to say it's great. It is necessary for effective tax planning. And the reason is that September 30th, that is close enough to the end of the year for us to get a rough estimate of what your tax situation is going to look like. And it's still far enough away from the end of the year for us to make some changes to help your tax situation. So I like to tell people that in this industry, this is not the industry for reactive tax planning. Of course, there are traditional tax strategies for every type of business, but for a normal company that's cash in, cash out, oftentimes your tax answer it kind of is what it is. In this industry, it's totally different. There are so many things that we can do between now and the end of the year that can significantly reduce your tax liability. However, they have to be done before the end of the year. And we also must know what we're looking like and to determine, hey, what route should we take, which strategies are available to us, and which strategies should we implement. And so I recommend to all dealers to have a set of financial statements prepared as of September 30th to kind of get that snapshot look of where you're at. And I'm not just saying this, it is, I believe in this so strongly to the point that, personally for our firm, I will not take a client who only has an annual financial statement prepared. And again, the reason why is that I don't want to know about your tax problem in March of the following year, right? I want to have some time to see what it is and see what we can do to change it before the year is up.
And Amanda, I wanted to, interject here. This is not, we're talking about it now because if you're not doing it, right, this is the time to start doing it. And you talked about quarterly, but it should be an ongoing process, right? It should be in every quarter, not just the end of the year, but if you're going to do it, at least do it by the end of September. Is that correct? Or by September 1st?
Absolutely, absolutely. Yes, all of my clients, they have a financial statement prepared either quarterly or monthly. And so for anybody who does not have financial statements prepared with any sort of regularity like that, at a very bare minimum, you should have that September 30th financial statement prepared so that you are able to do some sort of tax planning.
And this third bullet here, the last year and a half, 2 years have been really crazy in our market, right? There's been a lot of changes in the tax laws. There's been a lot of changes in the laws that impact, whether, people locally, laying people off, what kind of benefits employees we're going to get, which is impacting their decision and changing the labor market. There's been changes in the inventory market. Can you talk a little bit about maybe some changes you've seen your clients make from a financial standpoint in terms of the operational decisions they've made over the last year due to some of the changing market situations?
Absolutely. Okay, so this is a really important one to note because the last 2 years in particular have been weird for the industry. Collections have been at an all-time high. Usually in this industry, we can anticipate that, all right, well, fourth quarter will probably be about a break even. But these last couple of years, it's just been hey, we got to wait and see what happens. And with one of my clients, I made some big changes at the end of 2020 for him in anticipation of, hey, this is what things are looking like. Let's make these moves to help your tax situation out. And now I joke with him and I say, hey man, you should have given me a heads up that you were going to make so much more money in 2021. I wouldn't have changed what I changed if I'd known. And so really, you know, some of the biggest changes I'm seeing is that, you know, as much as the cost of inventory has gone up, the folks who have rolled with those punches and, you know, paid the premiums to buy those vehicles, they're all having pretty good years, pretty healthy sales. Again, collections are great. Everybody's had to make changes in terms of employees, and you know, we hear of dealers who are offering sign-on bonuses, and others who are you know, obviously having to give raises to everybody across the board. And you know, these challenges are definitely affecting everybody in the industry, and it's really just a matter of, you know, you've got to roll with the punches and make adjustments as you go, you know, because you can't just wait this thing out.
Right. And without the information, for example, I mean, we're going to talk about a lot of different areas that are impacted by what the interim financial statements say and what your projections are going to be. So we're going to get into those topics specifically later. But again, more importantly than ever, with the uncertainty, it's really important to just know where you are, right? I mean, in any given quarter, as you proceed, because things are changing so quickly.
Absolutely, absolutely. Yeah, and even, you know, normally when I work on a quarterly, this is something that we're monitoring year round for all of our clients, and as we should be. But you know, again, this year's just been kind of funny to where, you know, after June 30th, I'm thinking, man, you know, we probably need to make these changes, but hey, who knows what's going to happen in third quarter? So let's wait and see. And, you know, let's see what happens in third quarter. And if we keep up with that same trend, you know, we need to make these changes. If some of it dies off, then, you know, we can take another route. But we're almost to the point to where we're having to wait until, you know, until about this point to really make any kind of change, just because we can't reasonably predict the way that, you know, third quarter, fourth quarter was going to shake out.
And that's a great segue into this next section. We're going to, again, dive now into some of the specific areas, tax implications and year-end considerations that dealers have to make. So, you know, the importance of RFC, and I know Steve wants to just talk about the question of an RFC in general, but maybe start off with some, you know, higher level, you know, things for businesses with RFCs that they need to consider this time of year.
Sure. Okay. So with the related finance company, this is one of those examples of a strategy in our industry that can significantly impact your tax situation. And just a brief overview of how that works is that, you know, as a buy here, pay here dealer, you are required to pay income tax on the full gross profit of a sale in the year of the sale. So what that means is you can collect a $1 down payment, but you are still taxed on the full gross profit of that sale. And the whole purpose of the RFC, and something that it helps, you know, it helps mitigate that situation, because the rules for a finance company are different. So generally, your dealership is going to sell those receivables to the finance company. Because these are buy here, pay here customers, they're sold at a discount, you know, let's say 70 cents on the dollar. And on the finance company side, that discount is not taxable income right away. Instead, that discount gets amortized into income as you actually collect on the loan. And so what that allows is for the dealer to better line up their taxable income with their actual collections. You know, it makes a lot more sense to pay taxes once you've actually collected the money. And that's, you know, the benefit of using the related finance company. Now, this time of year, it's a good time, if you do not have a finance company yet, this is a great time to see, hey, where am I at for the year? Can I use the finance company this year? If so, how many notes should I sell? And how much money does the finance company need to buy those notes? And the major considerations for a finance company, if you're just opening one, because it's a related party transaction, there are some specific rules that go into it. Primarily that this transaction must be done at what's called a fair market value. You've got to treat it like you would if you were selling notes to a true third party. And what that means is that that discount must be reasonable. And the biggest issue I think that comes up, and one of the most, the toughest considerations when you're starting an RFC is that the finance company must have adequate capital to buy those notes, right? So it's kind of, this time of year, we're just close enough to the end of the year that we've got to make some moves. That RFC needs to be formed as a legal entity. Tax elections must be made. Both of the companies, one of the requirements is that they've got to be taxed as corporations. Probably 99% of our clients are taxed as S corporations. And all of the licensing must be put in place. Again, it's got to be a fair market value. The RFC has to be its own standalone company. And so all the licensing must be in place before year end. And again, that capital source must be in place before you can sell notes at the end of the year. And as long as you get all of that done by 12/31, you can process that transaction, sell those notes at 12/31, then you can get that deduction and that tax deferral. For those who are already using a related finance company, the question is, hey, do we need to sell notes before the end of the year? And again, if so, how many notes do we need to sell? What's it going to cost the finance company? Do we have enough money to pay for it? And so all of those things are really important considerations around this time of year whenever we are considering utilizing a related finance company to minimize our tax answer.
That's a really good explanation of that. And Steve, I know you had some comments here. We've got the input from the CPA. Steve, what from a legal perspective or from an industry perspective, I know you had some comments on this, so I'm going to let you talk.
So my observation is a lot of folks don't consider all of the consequences. You're setting up a separate company, like Amanda mentioned, that there may be licensing requirements in a given state. You have to consider whether you're going to have the RFC housed separately or housed together. A lot of our clients house it within their operations, but depending on the state you're in, that they may need a separate address. They may need to be registered separately. If you're going to be sharing employees, you've got to consider that and maybe have that agreement in place, have a lease agreement in place. But bottom line is that there's a lot to consider. It's not just, hey, call my accountant and they can get the ball rolling in a day. You really have to anticipate these things and be thoughtful in your approach ahead of time.
So the old adage of things in business, start with your attorney and your accountant first, and then make a decision, right?
Yeah, and speaking from my own perspective, if the client is calling me and they're talking to me about, well, how much discount and should I do this? And boy, I tell them, get on the phone with your accountant. I'm not qualified to talk to you about those things. You really need, the tax planning and the accounting advice. So it's really a collaborative effort between legal and accounting to get you to where you need to be.
Thanks, Steve. Appreciate that. And before I move on to the next slide, if you are considering an RFC or have one, you have any particular nagging questions in the back of your head, go ahead and ask that question. When we get to the end, we'll answer that. So anything RFC related that you're dealing with that you don't have an answer to that you'd like us to discuss, go ahead and bring that up in the question area. And in the next segment, we're going to talk here about reinsurance. And I know, I think we'll let Amanda start with the accounting side, and then I'll let Steve talk a little bit about regulators. Go ahead and talk about this with regards to year-end accounting, Amanda.
All righty. So reinsurance, similar to the related finance company, this is another great tax strategy for dealers, and this is something that I look at for my clients around this time of year as well. Reinsurance has some amazing tax benefits. Similar to the related finance company, there are some rules and regulations about transactions needing to happen at, a fair market value. While your CPA can talk to you about that a little bit and about the tax impact, you really want to rely on a reinsurance administrator, and you want to use somebody who is reputable, because these regulations can be pretty strict, and you want to make sure you're working with somebody who knows what they're doing. For us personally, I send all of my clients to Brett Buick at Buckeye, or Buckeye Brett as he's called, to help them with this kind of setup. And from my perspective, I look at reinsurance and I think, man, this is such a wonderful thing for tax purposes. It's always, I'm always at this point of time looking at my client stuff and assessing, hey, is there something else we can do with reinsurance? Can we add another product? Is there something that we can do at this time to help us? We've done what we can with a finance company. We sell all notes and we still got some taxable income left. What can we do with reinsurance to maximize the benefits of that and reduce our taxable income? And so I'm always looking at it, I can't help it as a CPA. I'm looking at it purely from a tax standpoint always. But there are other benefits to reinsurance in terms of streamlining operations and things like that are better to speak to a reinsurance administrator about. Yeah, I think that's.
Yeah, are there some products than others, or ones that you see utilized most frequently?
Yeah, I see. So I see CPI a lot, gap insurance, service contracts, warranty, and VSI. And it's one of those things. Again, from a tax standpoint, I love to see a warranty because dealers are doing it anyways, whether they know it or not. It's just a matter of accounting for it and getting the deduction for it. And so warranty is just pure deduction. I love it. Whereas from a dealer standpoint, they may be more excited about something like a service contract, which again has very good tax benefits, but it also provides another revenue stream. But yeah, I would say those are the top ones I see: CPI, gap, warranty, service contracts, and VSI.
This is definitely something that if folks on the webinar don't know, should definitely ask their accountant. Does this happen every now and then where you have a new client come on that is doing it but not taking advantage of hasn't been taking advantage of the tax benefit?
Absolutely, yeah, that happens all the time, and again, that really depends on the reinsurance administrator. Some of them set up the way that the deal is structured is, while there are tax benefits, they aren't as significant as they could be, right? And the way that they structure the deal is, the dealer gets more so the benefits from the operational standpoint. They do get the tax benefits eventually, but it's something that's going to, they will slowly get those tax benefits. Whereas if it's structured differently and structured in different ways, you can kind of get an immediate, deduction right then and there, and it basically maximize the deduction you can take. So yeah, I see that all the time, and I often see people who don't know what reinsurance is, or haven't, they're not using reinsurance, and generally it's because they're working with a CPA who does not have the experience in the industry to kind of give them a nudge and tell them, hey, it's time, go talk to these guys.
So it's a really good point. If take away on this slide, I think if you're not utilizing all of the different products, ask about them, but definitely make sure that in that question you ask, does structuring these things different ways impact my tax liabilities, and the kind of the plus and the minuses of that, right?
That's okay. Exactly right. That's exactly right.
Let me jump in for a minute, because in our new client questionnaire that we send to prospects, one of the things I ask about is, who's your accounting professional? The reason I ask that question is because I want to see, are they using somebody local that they may be their only auto finance or car dealer client, or are they using somebody that talks auto finance every day of the week? And that's a big part of the conversation when we first engage with somebody. What tools are you using? How are you setting yourself up? And it's always a comfort when I see somebody that is experienced and understands auto finance.
Great point. Thanks, Steve. And next, we're going to talk about the subject of major purchases. And I think there's a common wisdom or common knowledge that you want to make them at the end of the year. And Amanda, I know you want to talk a little bit about kind of the big picture do's and don'ts with this, but maybe also, what do you think most people don't know about this topic? Maybe end with that.
Sure. I'm gonna let Hugo take this one as the tax partner. This is more his area, but we'll let him take this.
Sure. So major purchases, obviously, everybody hears about, oh, let's buy a car at year end, to take the deduction, so on and so forth. The reason for that is bonus depreciation, or Section 179. Which deduction we take depends on the size of your company, what state you're in. Some states like bonus depreciation, some states don't like it. Also, bonus depreciation is going to start fading away with current legislation in 2023. That'll go down to 80%. So you'll only be able to fully deduct 80% of the cost versus 100% right now. The biggest thing to remember with vehicles, they have limitations for smaller vehicles, passenger vehicles, and you are not allowed to deduct personal use. So if you buy a company vehicle and you use it just to drive to and from work, to and from the lot, that you can't deduct that. That's personal use. That is not a business deduction. Right now, if you're driving from the lot to the auction or driving between different lots you may own, that is absolutely allowable. But with smaller vehicles, there's some limitations. We can only deduct up to $19,000 a year. But larger vehicles, if you're purchasing a tow truck, a cargo van, something that weighs over 6,000 curb weight, 6,000 pounds curb weight, those will be allowed to be fully deducted. So that's nice to have. That includes if you finance the vehicle. You pay $1 for it, you pay no down on it in December, you'll still be able to take that deduction in full in the year that you purchase it. Some of the other things that you may be able to purchase, if you have a shop, lifts, if you need a new tire changer, wheel balancers, some of these bigger tools that you have in your shop, all that can also be purchased as long as you have it in your shop and in use by December 31st. You will be able to take that deduction in full.
And are those, obviously large purchases for shops would be one that you would think of, but what other types of major purchases do you see most used? I don't know all the types because I'm not an accountant, but I sometimes think like if you're switching to a DMS or technology purchases for the dealership, which are really important. Let's say it's GPSs or something like. What kind of impact do those have? Maybe give us some examples you've seen.
Sure. So GPS units, typically there's a de minimis safe harbor rule. Anything that's under $2,500, and I make this election for all of my dealers, all of my business clients. Anything under $2,500 doesn't have to be capitalized. It can just be expense. So GPS units, since individually they're not that expensive, we can deduct those in full. But you're absolutely right. For a more expensive DMS system, or if you're having some custom modules built into a DMS or something like that. That's absolutely something that we might be able to bonus depreciate and be able to knock out in 1 year to take that deduction.
Okay. Were you about to say something?
I was just going to mention the biggest thing with this is I have a lot of people that will just go out and buy stuff to try to take the deduction. My recommendation is don't buy it unless you need it for sure, right? This isn't like a dollar for dollar reduction of your tax bill. If you spend, $20,000 buying something, again, tire list, posts, whatever, your tax bill doesn't go down by $20,000. It goes down by whatever tax bracket you're in. So this wouldn't be something that I do just to reduce my taxes, I would do it if I'm gonna, already planning on buying it, or if I know I'm gonna need it in the next 6 months, something like that.
Basically, if you're considering it, run it by your accountant. Don't do it. Don't necessarily listen to your friends on Facebook unless they're Hugo or Amanda about what they're doing. Talk to an expert before you make a major purchase. So great advice, Hugo. Tax deferral accounts, and this comes up a lot. I know us as a business and with other clients that we interact with, we have conversations. So first of all, when we talk about tax deferral accounts, what are we typically talking about?
Sure, this is what you normally hear: your 401ks, your IRA, traditional IRA, those accounts that we hear those buzzwords.
And just explain like how do they help? And if you're a business right now, and a lot of the folks who may be here listening already have these plans in place, so that doesn't impact them. But maybe there's other plans that they might add that give them a benefit, even if they add them later in the year. I think about things like, and I don't know if these are all on your list, but life insurance. I think about the where the company pays in a little bit. I think about the 401k where the company matched. I think about the medical insurance, or even help with childcare. Is that something normally that the amount the company pays is giving them a tax benefit?
Yes, absolutely. That would be a deduction to the business, and obviously a nice benefit for employees. Typically with tax deferral accounts,
is that something though they can maybe backload for a benefit, or are there dollar amount limits on each? What should a business be thinking about if they're thinking about this?
There are dollar limits. The biggest thing with these different types of plans is it all depends on how you're structured and whether you have employees or not. Right? There's different rules in place whether you have employees, and sometimes you might have to, if you want to put some money into these tax deferral accounts for your own benefit, you might have to, put the same percentage amount into your employees' plans, and so on and so forth. So there are some rules, and every situation is going to be slightly different depending on your operation.
Okay. Well, and again, it's not too late to start thinking about doing something this year, though, correct?
It's not. So that's one of the good things about these plans. If you don't have anything set up and maybe you just want to put some money into a tax deferral account for yourself, there's traditional IRAs which you can contribute $6,000 or $7,000 if you're over 50, and you actually have until April 15th of next year to put that money in for the 2021 tax year. There's also a SEP IRA if you don't have any employees. That's a great option, and you actually will have until October 15th, 2022, so just under a year from now, to contribute into a SEP IRA for the 2021 tax year. It's a little too late for maybe setting up a group plan for employees and setting up a 401k plan or something like that, but you can start working on that now to have it effective January 1st. Maybe offering benefits like these to your employees might help retain some of that employees. There's a lot of dealers right now are having issues with employees and being able to retain good workers.
I was going to say that this has come up in the context of everybody right now having to fight for employees and for retention, and these are almost becoming required, right, for people to take positions and stay.
Yeah, absolutely. There's it's becoming more and more the norm. People want to see that, and you having those benefits out there will help you retain good employees. And there's some tax benefits too. There's some credits for the first couple of years that you might offer a 401k plan. So there's some tax savings there as well.
Yeah, and I know we're talking about the great quit right now with folks leaving either their jobs in record numbers, and people can talk about the reasons, but the fact that they are is shows, number one, they have confidence that they can move somewhere, right? And that's generally why people are willing to make that decision. They have to know that they have somewhere to fall, and so definitely has become more of a consideration for 2022 for a lot of businesses. So I would definitely suggest, just talking with other businesses and the difficulty they're having in our industry and all others, getting in place that you talk to your accountant about, adding these kinds of programs, or at least being prepared and talk about the plus and minuses, because likely going to get in a situation where you're going to need those, right, to retain quality employees.
Absolutely.
With that, we're going to move on to the next slide here. Boy, 1099s. And I don't know, Steve, if you want to tell the story of the 1099s from back in the day first to kick off this slide or not?
Yeah, what Richard's referring to is that there was a dealer here in Texas that got in big trouble with the IRS for the way that 1099s were being approached. There is actually liability attached to this if you don't do it right. So listen to Hugo and Amanda and do it right.
When we talk about 1099s, let's just start off for 1099. I know we talk about vendors with 1099s, and then I think we also want to talk about in context of maybe the 1099-C. So I will let the experts talk.
Sure. So 1099s should be issued to any non-corporate entities when you pay them over $600 in either cash or check. And I'll kind of go into a little bit of the detail there. If you pay somebody via credit card, no need, because that merchant service provider is going to issue them that 1099K. This is only over $600 in cash or check. So there's a couple of different 1099s to keep in mind. The IRS last year brought back the 1099 NEC, non-employee compensation. So these 1099 NECs should be issued to vendors that provide any services. If you go and buy parts or something like that, goods, buying goods, 1099s don't matter. This is specifically for services here. 1099 miscellaneous is the next one, and those should be issued for rents paid. And even if you own your lot and you have to pay rent to a separate LLC, you need to issue that 1099 to yourself for that rent that you paid. Or if you just have a completely separate landlord, that's got to go there as well. One that's these 1099 miscellaneous that's commonly overlooked is if you are paying out referral fees or have any gifts or prize giveaways on your lot, and somebody has over $600 of referral fees paid to them in a year, you need to issue them a 1099 miscellaneous. The important thing on these is to get those W-9s now. We start worrying about 1099s on January 1st, January 2nd next year, and you start trying to collect those W-9s now. Some of these vendors are going to disappear. They're going to realize why you're asking for this, and they're going to not want to get issued that 1099 so they can try to get away with not paying tax on this money. Start collecting those W-9s now. Go through your list, go through your vendors list, see who you pay for detailing, different services like that, and start asking for those now, and do not pay them their next check until you have a W-9 in the file. That W-9 is going to tell you the information that you need to fill out that 1099 and whether you need to issue them a 1099 or not. Just because you cut them a check, you may not know that they're a C corporation or S corporation. You don't need to worry about issuing those guys a 1099. But if they're a sole proprietor, a single member LLC, a partnership, all of those different types of tax entities need to get those 1099s. And so what I tell people, start gathering those W-9s now. It's not going to hurt you. It's only going to help you, because come January 2nd, some of those people are just going to disappear. Last but not least, the 1099-Cs. This is huge for related finance companies. This only applies if you have a related finance company. Dealerships do not need to issue 1099-Cs. This is for cancellation debt. The timing on when these need to be issued vary by state law. It just depends. Here in Texas, we have strict foreclosure. So we send the 1099-C in the year that we write it off. In other states where you may be able to try to follow up and garnish wages and so on and so forth, you don't issue that 1099-C if you're still have any sort of collection activity going on.
That's great. That's often a question. I think that's the context of the situation Steve and I were talking about with that. So, definitely get with your accountant if there's a question on the 1090-C on what your requirements are based on your state, and then again based on your specific business rules and what you do. So, and then I know there's a couple different vendors in here, industry vendors as well, who are on this webinar, registered for this webinar. We always say it's a really good idea to include that in your welcome packet or your introductory packet from, if you're B2B, right? If you're providing a service to another company, go ahead and include that W-9 at the beginning so they're not rushing to ask you for it the last 2 months of the year, which we see a lot of. I'm sure a lot of you do. And deadlines. So definitely something right now getting, being on everyone's mind. And this is going to be our final topic for this presentation. So let's talk a little bit about that, Amanda. You go.
So deadlines, since we just got done talking about 1099s, we'll talk about that first. Deadlines to issue 1099s to your vendors, those cancellation of debt forms, those 1099-Cs or anything, they have to be in the mail by January 31st. The penalties for those are pretty steep. Penalties, if you don't get those 1099s out in time, start at $50 per form and go all the way up to $550 per form per 1099 not filed. So imagine, how many write-offs do you have on your related finance company? Multiply that times 550. If you never file these, those are some huge penalties that could hit you. So that deadline to get those 1099s out in the mail is January 31st. For 1099-Cs and miscellaneous, you've got a little bit of additional time to get them to the IRS. If you electronically file them, they don't have to be into the IRS until the end of March. But I would say go ahead and just get them in, get them done, because the penalties for that can be fairly steep. Then the next big tax deadline coming up would be the deadline to file S corporation and partnership tax returns. These flow-through entities are due March 15th. You can file an extension for those, and you have until September 15th to get them done. And then, of course, last but not least, individual returns and C corporations are going to be due April 15th. You can also file an extension on those and get them in. As long as you get them in by October 15th, they'll be timely filed. The big thing to keep in mind with that is extensions are not an extension of time to pay your tax due. It is only an extension to file your return. So make sure you get, a pretty good estimate. If you don't know the exact amount, a good estimate of what you owe by April 15th and pay that in, because on April 16th, the IRS will start charging penalties and interest.
And normally when, I know why people personally file for, extensions if they're, getting things together, they just need more time. But is it from a business, for a lot of the businesses that may be listening, the reasons they file for the extensions, are they making changes to prior periods? What kind of scenarios do you usually see for folks that request an extension related to that, specifically related to changes in prior periods?
Oftentimes it's just information gathering, and they just haven't been able to get all of the information they need to file the complete tax return. We extend a lot of our clients who have reinsurance companies because of that Form 8886. That Form 8886 is really, really important to file as part of your individual return and business returns if you have one of these reinsurance companies. But oftentimes those reinsurance companies' returns aren't done until the summer. So we file an extension for everything and then get it done as soon as the reinsurance company's tax return is done as well.
I want to add to that with, in this industry, most of the companies are flow-through entities. So the S corporations that, are not taxed at the entity level, but instead the income flows through to their personal return and is taxed at the personal level. And so often, even if the business return is ready in February or March, you still kind of want to get through not only that one, but also the individual returns. You want to see how it lands on the individual side as well. So before you, commit to anything on the business side, you want to see the impact that it's going to have on the personal side once you see the entire big picture for that individual's return. And so that would be another benefit to extending on the business side.
And the cost to consider is related to Hugo, what you said, if you have to have a good estimate, and if you underestimate, I guess, do you pay maybe penalty or interest on that underestimate?
Right. So if you don't pay in at least 90% of what you owe by April 15th, like I said, on April 16th, the IRS starts charging penalties and interest there. Luckily, right now, with the way the Fed rates are, and it's not a big number. I want to say we're somewhere around 4.5%. So it's not the end of the world, but if we can have a good estimate on April 15th, why not just go ahead and pay it in? We're going to have to at some point anyway.
Great. Okay, with that, we will end the formal part of the presentation, but we do have some questions for the group, and we are here. I will start with the first question, and then I'll let some of the others in the group ask about it. But we had a question of maybe ask for some more detail what we meant when we were talking about the structure of reinsurance impacting the having tax implications. What is that? What kind of a structure do you mean? Or is that something you as the accountant answer? Or is that something that the reinsurer should be able to answer?
I would say it's a collaboration of both. And I think that primarily is you'll have programs where you're paying the premium outright for warranty or service contract or whatever. With the amount that the dealer is paying for that product is paid in full outright, and it is deductible at that time. Whereas you do have other products that are kind of paid as you collect from the customer. So you almost, even though you get that tax benefit, ultimately the money goes into the reinsurance company, you get the tax benefit there, you are delaying that deduction that you can take because you're not really, you're not paying the premiums until, it's being amortized over the life of the loan with the customer instead of just paid outright and upfront.
Okay, Steve, did you get a question?
Yeah, this question has to do with size of the portfolio and when is the right time to be thinking about an RFC?
So you should start thinking about it as you are approaching about, I would say 500,000 in principal receivables. That's when you want to be thinking about it. Usually my advice to dealers about that size approaching that level is, get that September 30th financial statement done. And if it's looking like, hey, this is the year we need to pull the trigger, then go ahead and do it. If you know that you're going to continue growing for the next year, but you don't necessarily need it yet, go ahead and get the ball rolling on the RFC to use for the following tax year. But yeah, usually I say around 500,000, you need to start thinking about it. And once you get up to $1 million, somewhere in between there, it most likely becomes beneficial for you to use the finance company. And the reason it's like that instead of being beneficial right away is that there are additional costs associated with the finance company. Steve, you'd mentioned the different things that need to be in place beforehand. We talked about licensing and lease and agreements on sharing employees and things like that. The finance company also has to keep its own set of books. It's got to file a separate tax return. Those are all costs related to having the related finance company. So it's not until you hit a certain size that the benefits of the finance company start to outweigh the cost.
And let me ask you a follow-up question because this comes up pretty often. When it comes to the discount calculation, is that something that's based on historical? Is that something that an accountant figures out? Do you have to go out and get third-party bids? I mean, how do you figure out the discount that's going to withstand IRS scrutiny?
So I would always recommend to go get a third-party bid. The whole idea is that it's meant to be at fair market value, right? That means what would a third party really pay for it? Well, there's no easier way to substantiate that amount than getting a bid from an actual third party. And it is important to get that because the market changes. You know, we've all seen that with again, collections being so great the last, you know, couple years, the the market's willing to pay a little bit more for the notes than they would have, you know, just a few years back. And so yeah, I recommend to everybody to get that bid, that third-party bid, to help substantiate their discount rate. And it's one of those things that the IRS asks for, justification of your bid, and you hand them something from a third party. It's that's it. They asked the question, you answered it, and you move on to the next topic.
Right. Thank you.
Thanks, Amanda. And with that, we're going to kind of run out of time. We're going to do a little bit of housekeeping. Please stay and listen to this. We have some really important things to talk about. Quickly, the next webinar, Steve and I are going to close out the year. That's Tuesday, November 16th. Obviously we normally take December off because of Christmas, and a lot of folks are unavailable, but we will have our year-end webinar then. If you're already registered, no need to re-register. You'll automatically be registered for the next one, and you'll get a notification reminder email a week before that and a day before that. Also want to mention Training Unleashed, our online video platform, a training platform. We do have some videos coming out this week. Look on LinkedIn and Facebook for that. Also, Compliance and Cocktails. Go ahead and check us out on Google. It's the easiest way. Just Google that. We had Alan Dobbins in a talk about technology on this last one. It was really, really good. And then, Amanda, I want you to talk a little bit about this. This is one of the ways we connected on Facebook, and I want you to talk about the boardroom for a second, how people can become part of that group.
Sure. So we do have a Facebook group. It is called Buy Here, Pay Here, the Boardroom. And this group is basically a collection of Buy Here, Pay Here dealers and vendors who we go in there, ask our questions. Different vendors help participate to share educational information. So we have some of the industry's top vendors, and these are the guys who care about educating the industry as opposed to just trying to do a sales pitch. And so of course we've got Ignite in there to contribute. We contribute as well, and we have our other set vendors who come in and they'll talk to you about reinsurance, and they'll talk to you about GPS, and talk to you about compliance and financing and all kinds of good things that that the industry needs to know. And of course, we've got, we've also got all those dealers in there who go in there and ask their questions, and everybody's just so happy to help each other out. And so we've slowly built this group. I would say it's been around for about a year now, but we're really building it up to be a pretty good resource for the industry, and a great way to connect with other people who care about the industry and who are interested in learning more about their craft.
Yeah, and I love it. There are hundreds of members represented there from dealers all across the country, and it is a no sales zone. It really is kind of a peer-to-peer, let's share some information and talk about these issues. It is a great place to go if you're a dealer and you want to bounce some things around. It is a great group. So can they just look that up on Facebook, Buy Here, Pay Here, the Boardroom, just like that?
Yeah, you can just search for it. If you do a search in the groups and just punch in Buy Here, Pay Here, it'll pop up somewhere in there, or you can search, Buy Here, Pay Here with the colon and the Boardroom, or even just find me on Facebook, Amanda B. Sanchez, and I'll help you find it from there. So.
Great, Amanda. Thank you so much. And then save the date. This is it's in writing now, May 16th to 18th, 2022. We are doing our conference, Compliance Unleashed, here in the DFW area. So go ahead, please don't pencil that in, pin that in. We are excited to have our 3rd annual conference, and we look forward to seeing you there. We will be releasing more information here in the next few weeks, so keep your eyes peeled. If you have any questions for today, well, first of all, I'd like to say, Amanda, Hugo, thank you so much both for being here. It was a pleasure. Thanks for sharing that information. Their contact information is here. If you'd like to ask any questions or get in contact with them, it's info@butler-sanchez.com for any questions. And if it comes to info@ignitecp.com for our regulars out there, we'll be happy to forward that information along as well. So either one of those, if you have questions, we would love to hear from you, something maybe you didn't get to ask while we were here, or if you need a handout or anything like that. So thanks again, Amanda, Hugo.
Thank
you,
you.
guys. Thank you. And with that, I will let everyone go. Have a great rest of your day. Thanks for being here, and we'll see you next November 16th. Thank you.